Alright, welcome to episode 2. Today I'm going to be doing a video on SPACs, just like the basics to do with it. I won't be going over any like super complicated scenarios, so if you guys want that, let me know and I can do a part 2 and I'll go over stuff like FPAs and backstop agreements and all that and reverse redemptions, but it's a bit complicated and you really don't need to know that for the most part. So let's start. So I mean a SPAC, you can just see the definition there. I won't go over it, but think of it as a company that goes public, and their whole purpose is for another company to merge with them, so that other company can go public by merging with the SPAC, right? So the reason they exist is it's pretty much just an easy slash faster way for any company, whether it be one like DraftKings or a fraud like Nicola or whatever. It's just like an easier, faster, less hassle-free way for them to go public. Because that company already IPO'd, and I think part of the reason why IPOs can sometimes suck for companies is it can be a long process, and they have to do with the SEC and everything. But that's it. Now, really quickly, I'll be going over like the phase example for most of it, kind of like a timeline that you can easily understand. But the reason why you see most SPACs like NAV at like $10, or sorry, not NAV, have a price floor, is because that's pretty much the NAV. Because the way a SPAC works is, the people who put the SPAC out, they put in cash into a trust account, and if the merger fails, then they return that cash to shareholders. Um, and the other reason is, when you get a merger vote, or every now and then you have like a vote or whatever, you get a chance to redeem your shares. You could say, hey, I want to get rid of my shares, and you give me whatever the NAV is. They have interest as well, so NAV will start off at 10 usually, and it'll go up a couple cents every now and then. But we'll talk more about redemptions later. But that's why there's a price for it, right? So think about it. If this like fell down to 9, any ARB or anyone that has a brain will just buy that because they're getting a free dollar, with zero risk, right? So that's why you'll see them stick around. All right. So these are kind of like the stages. So the SPAC will go public. The SPAC will search for a target. The SPAC announces a DA. So that's like when they announce who their company is going to merge with. Um, and then there's a merger vote eventually, then they change ticker, then they file the S1, and S1 will eventually become effective. We'll go over that at the end. So first off, we're going to just go over the BRPM phase example. So BRPM was a SPAC, and later it became phase. But first off, I'll say, so usually when a SPAC goes public, I'd say 90% of the time, they do it via units first. And a unit in this scenario is just one common and a fraction of a warrant. So say they want to unit a million shares, it can be those a million shares will eventually split into like, let's say a million common shares and half of that in warrants. Um, in this case, it was 17.25 million units, which became the ratio is 1 to 1 for common, and then a third of that becomes warrants, so around 5 million warrants. And usually these splits take a month or two to happen, um, but it's kind of irrelevant because no one's. This used to be like a good edge back in the day, where you could kind of make money when the warrants were like higher price and stuff, but it's kind of dead now. So don't even waste your time thinking about that. And usually the warrants have 5 years to expire after the merger and exercise about 11.50. Sometimes you'll see a little bit longer, shorter, and very rarely different prices. I would say 9 times out of 10, 11.50. You can probably just assume that most of the time. So here's an example of the. I don't even know what it is. Okay, so here it says phase, but this is actually BRPM. It's just a change in obviously. So you can just see, you can quickly find out what the details are, and yeah, you can see how many warrants after they split the unit. All right. So then, okay, so in that stage is here. So we had the BRPM goes public. This is just a phase chart, so you can't see the units. Usually, when the unit splits, you usually get the commons and warrants trading, but not here. And then the unit splits, and then you get the phase, and you get phase W. Oops. Like that. So at the same time, 413, 414. And then this is when they announce the merger. Usually this is a non-event. because it's just a non-event. But at that time, DWAC was running, and Phase was hyped up, and it was just a good market for it. That we then had that big run for Phase. Okay. Now, this point, it's still a long way away from changing ticker. I think I have it in the next slide, or I had it in one slide, but it can probably take like 6 months or up to a year. Or sometimes they're quick, but most of the time they take a couple months to a year to eventually go through the merger vote and then eventually change ticker. All right. And so time passes, blah blah blah, and then they'll announce the date for the merger. So they announce like the date. I don't know if this is the right date here, and then you'll see all of a sudden NAV will drop. Now the reason why NAV drops is because just like with T+2, you have to own those shares for a certain amount of time before the vote for you to be able to elect to redeem your shares. Now, like I said here, don't think about shorting for this gap down. If you short here and then cover here or get short, and whoever you short against your borrow elects to redeem your shares, you'll just be in a really shit situation. So it could look like free money, but don't do it because it's not free money. I would just advise to not ever short equity before. You can do puts if you want, but don't do that. All right. All right. Next up, sorry, really quickly. So the reason why it drops is because there's no one there buying anymore to be able to elect to redeem their shares at 10, right? Because if you buy it from here on, you can't redeem your shares at 10. But if you bought it on this day or before, then let's say you managed to buy it, the low was 9.95. Say you bought it there, then 3 days later you can redeem it and you'll get 5 cents for free or whatever NAV is. Okay. All right, and then eventually you have the merger vote. I don't know what day it was, but I have the. Oh, I didn't show before, but this is just like what your typical deal announcement would look like. It's just an AK, nothing much to it. All right, and then um, let's say the merger goes ahead, the vote, sorry, and they approve it. It'll look something like this. Now, usually you won't get many details on this, but sometimes I've seen it where they'll announce a redemption straight away. But I would say most of the time, a couple days after is when a company will announce their redemption numbers. So this is where you'll find out how many shares were redeemed and what the float becomes. So in phase, not by the way, not every company will do it, especially like some random shitty Chinese companies, some shady ones, they won't say it. Every now and then you'll get a company that doesn't do it, but I'd say most do. This is why you'll see a lot of companies, like you'll see all of a sudden a SPAC gap up. Usually it's because of this, because people found out the float was like tiny or whatever. So let's look at this filing here. Oh yes, I have it here. So yeah, quick on redemption. So like if a SPAC has 10 million shares, 9% of that gets redeemed, then the float will become 1 million, right? Um, just spoke about that. So in this example of BRPM, it was going into the merger vote with 17.2 million shares. And we know if you look here, what I usually do is I usually go elect to redeem, don't find it there, redemptions, and there you go. So then you can see it's worded. Usually every company worded a bit differently. Sometimes you have to look at the exhibits, but in this case, you'll see here a total of 15 million shares, 15.8 million shares were presented for redemption at 10 per share. So basically, the float becomes 1.4 million. Now this is what happens here. So when that got announced in the after hours, when that AK came out, people just started buying it because at the time it was one of the lowest floats. Like to get a 1 million float DSPAC at the time was like absurd. Nowadays, I mean, we had one like a week or 2 weeks ago. There was 79,000 shares, but at the time that was very low. So that's why we got this run up here. And looking on the daily chart here, um, that was what this gap up was from here to here. So it took 2 weeks from when NAV dropped for them to announce those numbers. All right, so after that happens, um, actually this is not in any order. These two can be replaced, but you'll see an S1 will get filed. So it just looks like a normal S1, just like an IPO S1, and they just go over the company, the amount of shares they want to register, etc. Um, the key thing is though, until this gets effect, those shares are not registered. So for the most case, the shares you see after redemption is going to be the float until they get effect on this S1. Sometimes some shady companies will have some like non-locked up shares or whatever, and they can like finesse a bit and they'll do some sketchy stuff. But for the most part, just assume no more dilution until effect on the S1. And the next key thing, and that can take a while, like especially a foreign company, that can take over a year. American companies sometimes, I'd say probably 3 months. 3 months used to be the average. It might be a bit longer now. It used to be much quicker, but you know, as SPACs got shadier and shadier, SEC started being a bit more careful. Um, Now the S1 effect will usually add dilution by two things: warrants and pipe shares. So a lot of SPACs, as part of the deal, will get pipe investments, and those guys are, say, nearly never subject to any lockup restrictions, but they only can share when their shares are registered, right? And their shares are only registered when they get effect, okay? And the other way they can get dilutions via warrants, usually after effect, is when the warrants are exercisable, and that's also when you'll see the gap between the warrants and the commons close, right? So let's say the stock is trading at $20, then the warrants after effect in theory should trade at 20 minus 11.50, right? Because that's what you can redeem your shares for. It's hard to give I don't have any examples of my charts because usually people they'll redeem all the warrants and they'll disappear. Um, but one example was like Enovix, when those warrants were exercised. I think they just started trading together. I think they went up to $12 when Enovix went up to like 23 or whatever. However, before that, which is key, I'll go over later with the two examples, DWAC and ISPO. Those warrants technically don't have any value until either the merger closes, right? And until they get effect. If the merger doesn't close, those warrants go to zero. If they don't have effect, those warrants aren't exercisable. So technically, they're not really worth. It's kind of like an option call contract kind of thing. Yeah. So a key thing for why this S1 effect can cause dilution is, for example, with phase, won't go over to the technicals of the company, but they had a low float, 1 million, whatever, and it was like 3 or 4 million or more pipe shares. Eventually got effect, and you can see like as the more S1A amendments they got, the more pricing they got, and eventually, when they got effect, it just had a big gap down. That's where you'll get dilution when that S1 gets effect. But for example, you see something like OC. From my understanding, they don't even have a pipe, so I don't like if they got effect on this S1, which they filed after the merger, it shouldn't really do much because it's not even trading above 11.50, so those warrants won't add dilution anyways. And that's pretty much the whole process for a SPAC. Hopefully that makes sense. I'll just quickly go over like some examples. So DCFC, this was one that their lockup expired here. However, they didn't get effect until way after. So once they got effect, shortly after is when it got sold off. So that's a scenario to be cautious of if you're trying to trade one of these scenarios. Is just make sure those shares are registered and allowed to be sold. Because I'm pretty sure that's what happened here. Lockup expired. I think some shorts were in this, and then probably expecting it to get sold, got squeezed, eventually got effect shortly after they sold those shares. Embark, really quickly. Shitty company, got effect. Finally, those shareholders were able to get sell, and they got smoked. This was a good trade setup like last year. It's not really a big thing anymore, but every now and then you might find a good lookup gem in SPACs because I think most of the market overlooks SPACs, and especially the shady companies. All right, quickly I'll just go over simple examples of the warrants. So DWAC and DWAC-W. So you would think, right, if they're exercisable 1150, like I mentioned, they should trade at that kind of a difference. But as you can see, the high on that big day was 175, and the high on the warrants was not 163.50, right? The reason is, like I said, because there's that whole risk of either the merger not going through. If the merger doesn't go through, the warrants are worthless. They go to zero. And two, they're not going to be exercisable for a long time, right? First of all, DWAC's still a SPAC, so they haven't even filed an S1. it's just going to take months or even over a year for that effect to even come in. So you just have to think those warrants are pretty much they're pricing in the future, right? So in other words, like it's saying, okay, so what's DBAC realistically going to be in, let's say, 6 months' time, and when those warrants are exercisable? It's not going to be up here, right? Which is why, like, when that thing turns, it was just like really steady, clean fade, because it was just everyone knew DBAC would eventually be going down, so those warrants had no place being up there. Same thing happened with ISPOW. You'll see ISPO went up to, this one was actually closer to, because I think they had already filed their S1. But this was also the same example of redemption. They put out the redemption, low float, big move. This is probably one of the first ones of its kind. And you'll see this went up to 100, and the warrants barely went above 4 to 5. And for the exact same reason I said, the warrants are pricing in kind of the future when they're going to eventually be exercisable. And that's pretty much it. I mean, like I said, if you guys want, I can do a part 2 with some more specific, or not specific, I'd say complicated scenarios like we had with Lunar. Oops, no, this move on Lunar, etc. But this should be the basics. I think just to summarize really quick, we'll look at the phase 1 again. So BRPM goes public. They split the units. BRPM announces a merger with phase. They do the vote. They NAV drops because those shareholders have to own by a certain date to be able to redeem their shares. Then they announce a redemption. All of a sudden, get a low float, get a big, starts having some mild moves. Then S1 gets closer to getting effect, and the market starts pricing in those pipe shares coming into the market to dilute. And that's pretty much how most SPACs go. Like I said, some of them have some other factors. Not Envis. There's one SPAC, for example, that just had a ludicrous term and it just got cratered, from the DSPAC. But that's for another day. Did that help? Let me know if you have any questions. Thanks.